Hey everyone, Ben Nelson here. I hope you're having a fantastic day. Hey, I just wanted to get on here and if you've followed me and you look at my content, I try to do a consistent market update at least once a month. Not always perfect with that, but those take a lot of time. They take a lot of research, and I'm always looking at stuff with the market, but putting those all together, making them flow. Writing the script, because they are scripted. If you couldn't tell that, getting the editing done by my team, all that, it takes a lot of time. And the thing is that the market is changing on such a rapid basis right now. There's so many things going on that number one, once a month is not enough to stay on top of what's going on. And number two, I don't have enough time to do one of those every week. I just don't. I know there's other content producers out there that produce stuff on a very regular basis, but I'm just going to be real with you that personally, I'm out there doing business. I'm, looking at deals. I'm helping buyers and sellers and clients with their real estate needs. So I produce content because I love to produce content, and I want to be an educator, and I want to get this stuff out there. But I'm not a content producer as far as that's my revenue stream. Okay, and I'm not taking shots or anything. I'm just saying. My business is real estate. My business is not producing content, and that's great if people are doing that and they're able to, invest all of that time into producing content. But I'm out there doing business and doing a lot of other things. I don't want to neglect this, but I got to be, doing it in a way that I can still be doing what I'm supposed to be doing in my business, which is helping clients, talking to clients out there, being out there looking for deals, and managing transactions and all that stuff. So. With that said, I still want to get this out there. So I'm going to try something a little bit different. I'm still going to do my monthly, more scripted, kind of fun, putting stuff in there, putting the articles in there and kind of the fun stuff, the edited versions. I'm going to still really try to do that on a monthly basis. But again, that's not enough. So I'm going to try to do a weekly update as well. It's a little bit more off the cuff, not scripted, not really. I mean, a little bit more winging it, to be honest. I have some things I'm going to pull up here and share with you. But yeah, just to make sure that we're a little bit more up to date, and I'm not just doing once a month with the market moving so quickly. And on top of that, I'm also going to, as I see things, if you're watching on YouTube, or if you're not, go to YouTube. I'm going to be starting to do some more of those shorts. And when I see articles that throughout the week are intriguing or give a little bit of insights, I try to jump on there and do some quick thoughts on those articles as well. I love looking at articles and headlines and all that. I razz on those all the time with the clickbait stuff. But here we go. We're going to jump into a couple things. I'm going to try to keep this fairly brief. Bear with me. This is again, kind of a new format. It may not look exactly the same every time. The point is to get the content out there. Eventually I'll figure out, a good way to go about doing it, make sure it's fairly consistent and you guys know what to expect. So I'm just going to pull over here to some articles that I've been saving, trying to get ready for my updates here. And we're going to go over some of these. So there we go. So let's first talk about home prices. I say this in every video. A lot of I appreciate these articles right here that have, a little bit more of a breakdown of regional markets, because a lot of the headlines that you see are, they're national headlines. So they're speaking to generalities, and the market, there's things that interest rates for sure affect real estate on a national level, but they affect them all to a different degree. So you can't just say this is what's going to happen in the real estate market because interest rates are going up, or whatever the forces that you're looking at, supply and demand, all of that stuff, because every market's different. So I appreciate that this article is a little bit more nuanced in looking at separate markets. So this is a big thing that I want to make sure to get across, is that whether you're buying a single family home for yourself, whether you're buying investment property, you always have to be looking at your market and how is your market being affected? How is it likely to be affected? What's going on in your market? And I know I sound like a broken record with that, But if you're making decisions based on what is supposedly happening in the real estate market as a general term, you're going to miss out on opportunities because you're going to be making assumptions based on large generalized data and not what's regional to you. So that's kind of the first thing. So on that note, there are, really, where interest rates continue to go up. 30-year fixed rates are, upper sixes, low sevens now. They're up there. Compared to mid threes earlier this year, that's a huge difference. And it's a huge difference in payment, and it's a huge difference in cash flow for investment property, a huge difference in your outgo for your personal residence if you're buying right now. So what is that going to do to the market? Well, there's no denying that affordability is a big piece of this, right? So, there's only I've been saying in my updates that, okay, it's pulled certain buyers out of the market. Those entry-level buyers keep getting squeezed out, and that what that means for income levels continues to change because, 2 weeks ago, there were still people that maybe could afford it at the rates that they can't now, right? So, at a certain point, because I'm still very optimistic about real estate in general. We'll touch on some things there here in just a minute, but there is a threshold. There is a certain point where it's like, where is that tipping point for interest rates, and when it's going to have an effect on pulling back prices on housing. Now, there was an article, I think it was a Bigger Pockets article, right here. This is a good article to check out. The Fed basically admitted that they want a housing correction. So I'm not going to get into all of that. This is a good article to read. Check it out if you have a chance. Whether they're doing it on purpose or not, they're getting to the point where it's forcing the issue with interest rates. Now, again, and if you listen to my podcast with Grant Schroeder, Academy Mortgage, recently, we talk a little bit there about the Fed funds rate not being a direct correlation to mortgage rates, but I'm not going to get in the weeds on that now. Go back and listen to that episode if you want some insights on that. But the fact of the matter is that interest rates have been severely affected. They're a lot more expensive now than they were. It's a lot more expensive to get financing now than it is than it was back earlier in the year. And so at a certain point, you got to stop saying, well, it doesn't matter. People are going to keep buying. At a certain, it's gonna affect it. Now, where the breaking point is, I don't know. Obviously, again, it continues to push people out of the market the higher they go. But there are still buyers there. So, but when do those buyers stop buying because it's just too expensive, or they're going to wait it out? I don't know. I don't know what that threshold is, but we might find out, right? This is an old article, obviously, right? They top 6%. This is one I probably must have clipped a couple weeks ago because we're at 7 now. So I'm going to touch on interest rates really quick. I don't have an article for this here, but again, something we talked about in the podcast episode where we got a financing update from Grant was there are other loan options that are out there that people are starting to look to now. And your adjustable rate mortgages are becoming more popular again. And I know people hear adjustable rate mortgages and they start to freak out if they lived through the financial crisis because, we had all sorts of crazy things happen, and our adjustable rate mortgages were, maybe not the cause, but definitely, put fuel on the fire of a bad situation. And I would say they were maybe not the cause, but they definitely contributed to it. But they're different now. So they're different. And I know I'm going to get criticized from the critics on that, it's different now. Well, they are. Underwriting's different. The loan structure is different. People are doing longer term arms. So we're not talking these short, 1 or 2 or 3 year arms. We're talking 7 or 10 year arms. They're long enough to go through a cycle and see lower rates again to be able to refinance before they adjust. People are getting qualified based on that interest rate and based on, some of these kind of step up programs where your interest rates, lower now than it is, next year, and it steps up to a higher rate over a few years. When they were doing that back before the financial crisis, people were only qualifying based on the lower payment. People were qualifying only based on interest only payments. Your entry level payment versus now, if you're getting a loan that is 5% today, 6% next year, 7% for the rest of the term, you have to qualify for the higher interest rate payment. So there are a lot of differences between the loans now, and that's just one example. But I just wanted to speak to ARMs because, again, they just have a negative connotation to them because of what happened in the financial crisis. But they are a great tool. They are a really good tool to get in with a lower interest rate that's much lower than a fixed rate, and have some runway to be able to see what the market's doing to let interest rates come back down, which may or may not be in the next year. I mean, it's hard to say, but everybody's maybe not everybody, most are projecting that, this is kind of a short-term scenario trying to fight inflation, and that eventually we'll work our way back down. Probably not to, upper twos, low threes like we saw for mortgage rates, but more, 4.5%, 5%. We're not going to live in this 6.5%, 7%, 7.5%, and maybe higher here in the near future. I'm not sure. We're not going to live there forever, right? So getting in now with a long runway on an ARM with a lower than your 30-year fixed rate, and then with a plan to refinance in 2, 3, 4 years, I think is a good plan. Okay, let's jump over back here again to a couple more things. So home sales. So yeah, cancellations, our home cancellations, lower home sales, all that stuff. But again, last year, the last 2 years, really, I mean, the home sales were way higher than normal, and so if you're comparing year over year numbers, it's really a skewed view on it, because you have to look at the historical norms and not just compare it year over year. Yes, numbers are down year over year on a lot of things. Yes, there are home cancellations. But there's still people buying. Here in the Portland metro area, we actually went down in our inventory in this last month. When we're looking back at the month of August, I know we're almost the end of September here. Obviously everything's in the rearview mirror, but I was fully expecting, we were at 2 months of inventory in July. I was fully expecting August numbers to come out and that we were going to continue that trend up. Maybe be, nothing crazy, but maybe be mid 2 months, maybe edging towards 3. And we're at 1.8 in August. So it'll be interesting to see what the September numbers are when those come out in a couple weeks here. But there's obviously still buyers out there that are looking. They're just having a little bit more say in what they get versus having to just kind of beg a seller to sell them the home, right? So there's more seller concessions, more negotiating on repairs. We're seeing builders slash some prices that when they were really pushing them, higher. Every single sale was higher than the previous. And so it's leveling out, and they're offering concessions. And one of the big things now is again, you can buy your rate down. So a seller concession to pay some closing costs, buy that rate down. You can get that fixed rate down to a little bit more reasonable rate. So just something to look at as you're out there, whether you're buying your own residence or an investment property. Can you buy that rate down and get a little bit better rate? Because that's a possibility. Let's see, what else can we, again, winging it a little bit here, just trying to go through some of the headlines, but so bear with me. Again, some declines in certain cities, you're going to see that. Typical value of home fell 0.3% in August from previous month. It's not a lot. That's what is that for the year? Like 3%, something like that, right? So 3.5. Nothing. Again, we had prices drop 20, 30, 40% in the financial crisis. So even this prediction, where there's some markets 15 to 20%, you're still, that's not great. Obviously nobody wants to buy at the top of the market, but again, think long-term, buy in markets that are going to be good for the long term. Rents are going to continue to go up probably in a lot of markets. So what are your other options, right? What are your other options? You always got to do compared to what, and not just, am I buying at the top of the market? What are your other options? And again, there's still, right here, 6 big markets where home prices might still be rising. There are definitely markets that are, even in this interest rate environment, are going to continue to rise because there's other factors that are going to push up those prices. Now, I would say even in those markets, again, where's that threshold of interest rate, and that finally having a leveling off or pulling back, I don't know. But at some point, the cost of money would affect pretty much every market, no matter how healthy it is, because a big function of home prices is the cost of the money. Okay, let's see. I want to jump into one last thing here. So this is a big one to me. New construction. So back in the financial crisis or before, there was a huge oversupply of housing in the financial crisis. We just had, and there's a lot of factors to that. There's just so much building going on, and then there was a slew of foreclosures, right? And just a lot of things that, if you look at the data and you look at how short we are, again, nationally, you got to look at your local markets, but we're 5 million housing units short, and now new construction is slowing down. Builders are being cautious, right? So they're, building permits are down a little bit, and just builders are being more cautious. They're not putting their head in the sand and saying, let's just keep building and everything's going to work out and no problem. So they're being more cautious because a lot of these builders got bit a little bit back in the the financial crisis, and so they've learned, right? So they're trying to be smart about it and not just continue to fill the market with inventory. They're holding on to some of their cash. They're being careful about how they're approaching their building, and I think this is a good thing. So in the end, I mean, unfortunately, this doesn't help our housing shortage. But on the flip side, as far as pricing, now you've got a continued issue with supply and demand, which, even with the cost of money being higher, again, that's going to offset to some degree the house prices, whether they're going to stay steady or go up or down. If we're not continuing to fill the market with inventory, then we're going to have that supply demand constraint that's going to continue to prop up prices. Now, the other side of it, so it's interesting. I think I don't remember who I was talking to about this the other day, but I feels like there's for a lot of sellers, there's always a reason not to sell, right? So 6 months ago it was, and for the the year prior, there was a lot of sellers that wanted to sell, that wanted to they wanted to downsize, they wanted to upgrade, whatever their scenario, but they didn't feel comfortable with it, because it's like, well, how can I sell? Because I don't have any concern about selling, right? I'm going to put it on the market and I'm going to get a dozen offers on the first weekend. That's not the problem. The problem is I got to buy something on the other end, and now I'm one of a dozen offers. And so what do I do? How do I make this transition happen comfortably? Or even know that I'm going to be able to find something to buy, right? That's a really hard scenario. So some sellers just opted not to sell because they just couldn't handle that. And they didn't, the unknown and the stress, and just even trying to know if it's going to work out. I mean, there are buyers that put 15 offers on places and never got something. What if that's me, right? And I've already sold my house. And now it's like, now there's a lot of sellers that have, maybe it's a better environment now to buy, because they're not competing like that. And it's still a decent market to sell, but they're questioning that. Well, they're like, well, now if I have to borrow money, I have this fixed loan that I bought this property, 5, 6, 7, 8 years ago, and I refinanced it since, right? And so my rate is 3%, but now I got to go buy at, 6.5, 7%. Now it doesn't make any sense because of that, right? So I just think it's an interesting nuance. And again, another thing that's going to continue to that's not every scenario. Again, we talked about being a little strategic with ARM loans, thinking down the road. You can upgrade now, you can refinance later, but you got to be able to cover the payment now, right? It is going to be a higher payment now. But again, that's another thing that could constrain the market, is people that are like, well, I would like to do something, but I can't trade my 3% interest rate for a 7% interest rate. I don't want to, or I just can't afford that. So in the end, again, home sales are down. The market, I feel, is leveling off. I feel like it's honestly a little bit more healthy than it was uh, for the last, in the spring and the year or so prior to that, because it was getting really, really overheated. And some of these markets, again, that are more poised to pull back, those obviously got extremely overheated to the point of getting prices going out of control to the point where now they're going to see that correction and the pullback. But I think it's a better time to buy right now. I think the market's leveling off. I think there's going to be a lot of opportunity to get in now. People are looking to invest in real estate still because we're still seeing inflation. And people see the long-term benefits of investing in real estate. And in the long run, it's going to be, if you buy smart, you buy in a good market, you buy a good product. We're short on inventory. We're going to continue to be short on inventory for a long time. Real estate is a good investment, and people understand that. So, the other thing that we're seeing a lot more. So again, house hacking, and renting out spaces, looking at opportunities to buy things that are 2 to 4 units as an owner occupant. That's another way that you can look at offsetting that higher interest rate. People were starting to do that already when prices were accelerating so quickly, but now that's a really good way to look at offsetting that higher interest. Is if you buy something that has multiple units of rentable space, you can rent that out and you can still get a payment that is going to be lower than if you rented a place. And now you've got an asset that, again, you can refinance when rates are lower. You can start paying that loan down, all of that great stuff. So thanks for bearing with me. Again, this is going to be an ongoing thing. I'm going to jump on and do this once a week to try to give you guys some updates and keep on top of what's going on in the market. So make sure you're checking it out. And I'll continue to get better at it and get consistent in the format and all that. But hopefully, again, my intent is to get this information out to you. I'm out there on the streets. I'm out there working with clients. I don't have time to sit and write content and scripts and all that stuff and record like high quality video to put stuff out, on a daily basis. That's just not what my business model is. But I want to make sure you're informed. So I'm getting this stuff out here in whatever way that I have to do that. Make it a great day, and we'll catch you guys next time.